All right, Bismillahir Rahmanir Rahim, Alhamdulillahi Rabbil Alameen, wassalatu wassalamu ala Muhammadin Sayyidil Mursaleen wa ala alihi ajma'in. Amma ba'd. Thank you everyone for joining the session today. This session is jointly organized by TAIF as well as Adil Advisory. TAIF is a edutech company for Islamic finance sector. Adil Advisory is a share advisory company based in Malaysia, as Brother Ahsan has nicely introduced. And today, myself, I'm Yousuf Sultan. What I'm going to do with you, inshallah, is especially for the upcoming CSAA exam candidates, the AAOIFI Certified Shariah Advisor and Auditor exam candidates, we'll have some discussions, inshallah. Now, initially, when we used to do this session, we used to have a set of presentation slides which were presented, and then some questions during some quizzes basically. But what we found more effective last time is we asked everyone to share the questions they have, and based on the questions we basically answered or discussed during the session, right from the Shariah Standards, AAOIFI Shariah Standards. So we're going to do something similar, inshallah, today. And I have already a few questions in my WhatsApp as shared by Brother Ahsan from the form submissions. So we'll try to go through those. Other than those, if there is any other question, please feel free to share so that we can go through those questions as well, inshallah. Brother Ahsan, would you like to also share those questions in the chat box? But nonetheless, never mind. I think I will start with some of the questions, inshallah. Okay, so the first question asked was, is it permissible for the institution to demand wages for services rendered to the holders of the current accounts? So I believe this is, let me share my another screen. All right, I believe this is catered in the Shariah Standard on banking services in Islamic banks, most probably, if I'm not mistaken. But let me just quickly go through it. So as you can see here, the institution may provide additional services to the owners of its investment or current accounts when they desire so and charge fees for such services, right? So the question was, is it permissible for the institution to demand wages for services rendered to the holders of current accounts? The answer would be yes, as we can see, because it mentions clearly that you can, the institution may provide services to current account holders, and they can charge fees for such services as well, right? And the institution may provide free services also to the owners of its investment or current accounts, provided that the services rendered to the owners of the current accounts are not set as a precondition or constitute a traditionally observed prerequisite for opening the account. Now, what is the issue here? The issue here is current account is often considered based on Shari'ah TAIF, or based on the Sharia basis of qard or loan, whereby the depositors are basically lenders and the financial institutions are the borrowers. Now, for the borrowers, we know the prohibition of giving a fixed return or additional amount, which is tantamount to interest or riba. That one is very obvious. But even if it's a non-monetary benefit conditioned to the loan, For example, if you give me a loan, I will not, if you give me a loan of, let's say, $1,000, I will return $1,000 as well. However, I will also give some service to you, right? So this additional service or additional benefit is not a monetary return, but it's a non-monetary benefit. Now, the moment it becomes conditioned to the loan, it also tantamounts to riba. So that's what it's saying. As long as the services are not a precondition or constitute a traditional observed prerequisite. Now, when we are charging fees, it separates between the loan, because from the current account point of view, if we consider the banks as borrowers, now they are not benefiting from the loan. They are basically providing separate set of services and charging fees. So we don't have the issue of this second clause. So I hope it makes much more clarity to the one who questioned this. And if you have further question, you can ask, inshallah. The second question was, does disposal of assets include making donations? Is this conditional or mandatory? Disposal of assets including making donations, is this conditional or mandatory? The question is not so clear. But if we understand the rightly, if the question is like, is the disposal of asset in or let's say making donations conditional or mandatory, meaning that, for example, when there is a require of purification, right? So I think most probably you will find clauses on this, most probably around in, let's say, financial papers in Shariah Standard number 21, and perhaps few other Shariah Standards as well. So let's say you have some prohibited income that has entered into the balance sheet. Now, how do we take care of those? So of course, it has to be disposed of, and it would be yes, mandatory. If I understand the question correctly, the answer would be yes, it is mandatory, because the shareholders need to cleanse their income, purify their income by getting rid of the prohibited income. Now, how do they do that? So they will take account of the total prohibited income that has been generated. So if we consider from financial institution point of view, so whatever activities considered or marked as Sharia non-compliant, any revenue generated from those activities will be also considered non-compliant, and that has to be purified by dispersing of. It's mandatory. And not only that, but as part of the good practices of Sharia governance, it will also be reported at the year-end Sharia review report by the Sharia Supervisory Board as per the Sharia governance standards number 1 and further other governance standards as well. So I hope that answers the question. Next question, is it permissible to perform barter and deferred payment sales except with the prior consent of principal? Okay. If now, who is the principal here? Are we talking about an agency contract? If it's an agency contract and then the agent is doing a barter or deferred payment sale, so I'm trying to understand the logic of the question or the rationale behind the question. Maybe the rationale behind the question is, does the agent or is the agent, let's say in a wakala, is he allowed to do deferred payment sale, right? So in agency contract, and not only in wakala, we have the same issue in, let's say, mudaraba, where the mudarib also has a role of being wakil or agent on behalf of the Rabbul Mal, or the owner of the capital provider. Similarly, in musharaka, the sharik mudir, the one who is managing the business, he also acts like an agent for the other shareholders, right? So the management is like an agent on behalf of other shareholders who are not participating in management of the business. So in all such cases, the agent is usually allowed to do things, number one, which he is explicitly allowed to do, right? So for example, the principal has told him, okay, you can do this business, or you do this one, or you manage in that manner, so you can do those things. Number two, he can also do things, especially for mudaraba musharaka, where he has to, manage business, and definitely you cannot interact in day-to-day business decisions, right? And that is something not allowed by Sharia as well, for silent partners to involve in day-to-day decision-making process, because that will hinder the business management process. So in those cases, he's allowed to do some decisions which were not discussed earlier, right? However, he is limited to things that are considered customarily for the business, not against the business. So for example, can he give loans? No. Why? Because giving loans has no returns, right? So he's not making any profit out of it. In both mudaraba and musharaka, the subject matter of the contract is a ribh, or making profits, generating profits. So since he is not making any profit generating activity, and since it does not contribute indirectly to the business as well, like for example, when you are expending for marketing, right? It's an expenditure, but it contributes to sales, to making more revenue, so that's fine. But giving out loans, giving out donations, right? Those things are something, those are not for profit, right? It's more not for profit. So in those cases, they have to take explicit permission or approval from the shareholders. That's a very general Sharia principle. Now, barter trade, I don't see any issue in line with AAOIFI Shariah Standards, as well as general sense of fiqh mu'amalat, because barter trade is also considered a type of trade. It's just that you pay, instead of through currencies, you pay through commodities. That's the only thing. So as long as business wise it is something acceptable and it doesn't make a major issue or concern, I don't see any further issue. All right, can sukuk be issued without specifying a period? What is the reason? I don't see any restriction on the period as per AAOIFI Shariah Standards, but we can have a quick look. So it's basically 17, Shariah Standard number 17, investment sukuk. If you look at the Shariah Standard, I don't think they specify any specific period. Basically, we have to look at the underlying rationale behind sukuk. Now, if you look from Sharia point of view, sukuk is papers representing some assets, or basically some assets in case of asset-backed sukuk. As we look at Sharia governance standard on sukuk on by AAOIFI, we will see that it's mostly talking about asset-backed sukuk. Now, if it's asset-based sukuk, still there will be some asset or some revenue-generating thing to look to refer to. Now, in all such cases, we may or may not have a definite tenure. But if we look from bond perspective, why we come up with sukuk? There was already shares, for example, right? Or other types of financial papers. But why sukuk? To resemble the characteristics of conventional bond, of course, as an alternative solution that follows Sharia principles. Now, from that point of view, we can have a period, but that's not a Sharia requirement. So often we may have a requirement as a Sharia requirement, we may have a requirement as a governance requirement. So I don't see this as a Sharia requirement. What I would suggest, I think some of the questions we already have like that. If you ask based on a very specific Sharia standard and clause, it's easier for me to go back and share with you right from the Sharia standards. Okay, now I will pause a bit from the questions received from the forms and go to the live questions, some of the live questions. So for example, we received a question from Shakir Hussain. Is it permissible to make a murabaha contract on deferred payment basis through gold? Okay, so we have few things. Let us go quickly to the murabaha Sharia standard number 8. Okay, so first question is, can we do murabaha based on deferred payment basis? we can do in general. That's the practice in banking murabaha, right? Murabaha, just to recap, murabaha is a sale contract where we disclose the cost as well as profit. So it's a sale on profit, but the disclosure is there. That's the distinguishing element from any other general profit-bearing sale. Now, in banking murabaha, what we do is the customer comes to the bank or financial institution, places a requisite for the product that he wants to get finance for, and then the financial institution would purchase directly from the vendor, or in dire needs as per AAOIFI standards. In dire cases, the institution may appoint the client to become an agent of the financial institution and thereby purchase the product, own the product, and then submit the possession, the constructive possession or actual possession to the financial institution, and thereafter conclude the murabaha, aqd al-murabaha, the contract of murabaha with the client, right? And the client usually, of course, he needs money, he needs to get finance, and that is why he comes to the financial institution. So the payment generally would be deferred, no issue. Now the question would be, can we have the deferred payment basis through gold, meaning that we determine the currency as gold, and then on the other hand, we have the murabaha assets. So let's say the financing is for auto financing, a car, but the price would be paid in gold, and the gold would be deferred. Now, does it fall under sarf? No, it does not fall. If it falls under sarf, we have the Shariah standard number 1, which is trading in currencies. So in Shariah standard number 1, you will see the two conditions. Basically, for example, number 1, both parties must take possession of the counter values, right, before dispersing. So the possession could be actual or constructive. And if we are having same counter values, so let's say in this case gold, whereby the murabaha asset is also gold, in that case it has to be equal amount. So can we do murabaha, spot murabaha on gold? Cannot, because what would it mean? It would mean that we are selling, let's say, 10 grams of gold for 11 grams of gold. So we cannot do that as per this ruling, because it will not be an equal amount. Now, can we sell, let's say, silver for gold in a deferred basis? Cannot, because in sarf is where in both counter values are gold, silver, or any other modern currencies. Now, in all exchanges of currencies, one mandatory requirement is it has to be basically the position must be there. It must be spot, right? So spot transaction. Now, in order to fulfill that requirement, anytime we have such transaction, it must be always spot, and we cannot have it deferred. Now, if it is not a currencies exchange, meaning that in one end there is a currency, of course, there could be gold, silver, US dollar, Malaysian ringgit, whatever. And on the other hand, we have some assets, some commodity, etc. Now, can we defer that gold or silver or currency? Yes, definitely. That's the whole point of putting that in this Shariah standard in murabaha, right? So the answer is yes. We can have the gold deferred as long as the murabaha asset is also not gold or silver or any other currency. Okay, next question. Can you please explain Shariah standard number 14.331? Okay, let's go. So Shariah standard number 14 on documentary credit, clause 331. Okay. Sorry. Yeah, I believe this one. All right. 331. Yeah, this is the one. Okay. All right. It is permissible for the institution to charge actual expenses incurred in issuing documentary credit. It is also permissible for the institution to charge a fee for providing the required services, whether such a fee is in the form of a lump sum or certain percentage of the credit amount, provided that the duration of the credit is not considered in determining the commission. This rule applies to services rendered for both import and export credit, except where the amendment involves a rescheduling of the duration of the credit facility. It is therefore permissible for the institution to charge only the actual expenses incurred, in which it will be a definite sum and not a percentage. So basically, when it comes to issuing a documentary credit or letter of credit, let's say LC, right? Can the institution charge fees or not? So the first thing it mentioned is that it can charge actual expenses. Now, what if it is providing some additional services, right? So in that case, the institution can charge a fee providing the required services, for providing the required services, meaning the additional services. Now that fee, remember this fee is not just to issue the documentary credit, but it's also for additional, it's for additional services. So in that case, it can charge a fee, and that fee, just like any other service fee, if you go to Ijara Shariah Standard, you can see the service fee. The fees can be determined as a lump sum, or it can be a function of a certain percentage of if it involves some amount, so it can be a certain percentage of amount as well. So that's fine. Now, the moment we go to the percentage of credit amount, there is a very gray line or thin line with riba, with prohibited riba, and this is why what AAOIFI is saying, that provided that the duration of the credit is not considered in determining the commission. So basically, the commission must be something flat. It shouldn't be variable with the duration. So it's not like if the credit is for 1 month, then the fee is like let's say 3%. If it is for 3 months, it's 4%. It shouldn't be like that, because the charges are not for credit, rather it's for the additional services. However, the fees are determined in relation to the credit amount. So both are two different things. We have two different things here. One is the issuing documentary of credit, and we are charging actual expenses. So that's separate. The other one is we are giving some additional services. But to determine the fees, we are connecting it with the credit amount. So AAOIFI Shariah Standard is saying that's fine, right? But it shouldn't be a variable. It shouldn't be that the duration of the credit also becomes a variable here. The moment it becomes like that, it will be Sharia non-compliant. So that's the main thing. And then it further says that the same rule applies to both in case of import or export credit, except where the amendment involves a rescheduling of the duration of the credit facility. It is therefore permissible for the institution to charge only the actual. Now, what happens when it comes to rescheduling? So remember, previously it is mentioned that the duration should not be a function, right, of the fees. So when it comes to rescheduling is basically to extend the duration, right? So in that case, if we vary the fee, increase the fee in line with the duration, we have the same problem again, Sharia problem again. So what AAOIFI is saying, that in that case, the institution will only charge the actual expense incurred, right? And that actual expense is the expense for rescheduling it, nothing else. And that should be a definite sum, not a percentage. Because the moment you go percentage here, the question would be what additional thing you have done, right? So it has a high potential of being a Sharia non-compliant. So that's the main thing. In addition to that, there are a few other things in this clause. It is mentioned the institution must abide by the following conditions. Number one, the aspect of guarantee per se must not be taken into account when estimating fees for documentary credit. This is a Sharia. The basis of this is from Sharia perspective. If you look at fiqh literature, guarantees are seen as an act of tabarru'ah, as an act of charity, and you shouldn't charge for it, right? So that's the reason why just taking the aspect of guarantee should not be the reason of charging any fees. Rather, there has to be some additional services which I already mentioned. Accordingly, it is not permissible for institution to charge an amount in addition to the actual expenses incurred if it endorses a credit facility issued by other bank, because endorsing a credit facility in addition over because endorsing a credit facility is an addition over guarantee. So basically, the rationale is same. The moment you detach the services from issuing documentary credit or guarantee, we don't have any additional rationale to charge fees as per AAOIFI Shariah standards. So if it's from a separate bank, it has the same issue again. So that's the reason why it's mentioning. I'm leaving out the rest of the items. And then there's number 2, the issuance of credit facility should not involve riba bearing profits or become a means of such profits, which is a principle in every single transaction or activity that we do through Islamic financial institutions. It is not permissible to use a combination of contracts in documented credit as an excuse for involvement in the prohibited transactions, such as taking a commission for providing a guarantee or extended loan. So as you can understand, what AAOIFI is trying to ring fence is that the moment we issue documented credit or guarantees, we should only charge actual expenses. We can charge fees for additional services provided, where the fees can be determined as a function, as a variable, or as a percentage of the credit amount. No issue. Until then, no issue. But the moment we go beyond that and we put something else, put some more contracts together, the main objective is basically to charge fees against credit being offered, right? So this is where it will be a Sharia issue, and that's why it's saying clearly that it is not permissible. So I hope the clause is clear now. Mohammed Sajjad, Jazakumullah khairan. Can you briefly explain with examples of possible types of agencies under SS 23(4)? Okay, let's try. Inshallah, SS 23, clause number 4. Okay, the types of agency. All right, so number 1 is specific versus general agency. Right? In Arabic, in fiqh literature, it is known as ajir khas versus ajir am. Now, ajir am or general agency includes all methods of disposing of assets, provided that the interest of the principal and the sorry, I'm wrong. The ajir khas and ajir am is where we have the ijara or the service provider as an individual. Here we are talking about agency. Bit similar, but not the one that I was talking about. Sorry for that. So a general agency would mean that all methods of disposing of assets will be included, provided that the interest of the principal and the customary practices are well observed. If you recall, in my response to the very first question, when I was talking about if the agent is allowed to do barter trades or something else, I was explaining in detail, right? So basically, general agency is like I'm appointing an agent to dispose of asset. He can do any method, but as long as he is doing that at the interest of the principal and also bearing the customary practices. And it also mentions, see, the disposal of assets here does not include making donations. This is exactly what I was talking about. Unless the principal authorizes the agent to do so. So not only donations, it will also include giving loans, for example, or selling at a very low price, or purchasing or procuring at a very high price, also known in fiqh literature as ghaban fahish, right? At a very high price or a very low price. So in all those cases, it has to take authorization from the principal, from the muwakkil. So these are, and in a specific agency, it's basically very specific. For example, you can only dispose like this based on that. So the conditions will be all specified. Limited versus absolute agency. So absolute agency is bound by customary practices and the interest of the principal. It is not permissible in absolute agency to sell at less or buy at more than the market price, nor is it permissible to perform barter and deferred payment sales, except with the prior consent of principal. I think something similar that I have shared earlier as well. So I hope this is also clear. paid versus non-paid agency. Basically, wakala or agency can be paid. There can be fees paid to the agent. It can be also for free, right? So both are fine. Binding versus non-binding agency. It has further clarification in item 4.3. Basically, one would be binding and other one would be non-binding. So what are the cases when it will be non-binding? And later on it explains. Temporary versus continuous agency also being explained further. So I hope the question here asked does not require further explanations. So I'll just stop here. How financial institutions and banking methods handle funds obtained from financing results that have elements of shubha? Okay, very general question. Again, I would request all of you to ask questions specifically on Shariah Standards so that we can prepare better for our exam. But let me try to address in a very brief manner how financial institutions and banking methods handle funds obtained from financing results that have elements of shubha. Now, what I understand from the question is sometimes maybe there are some income generated from some financing which has an element of shubha, means a bit of doubt, right? It may be riba or it may not be riba. It may be prohibited, it may not be prohibited. So when it comes to Sharia governance practices, the role of Sharia Supervisory Board, and then further the Sharia, internal Sharia audit, internal Sharia review. So basically what they would do, they would try to figure out how much of that is considered prohibited. So the moment it is identified that this amount is prohibited, then there has to be disposed of to charity. But if it is not confirmed as prohibited, then it will go into the revenue of the financial institution as per their practices. I hope that answers your question. Okay. Assalamu alaikum. Can mudaraba be benchmarked? I believe the question is like, can we have a profit share which is benchmarked? Most probably you are asking something like that. If that's the question, let's go to quickly in mudaraba. So just to recap, mudaraba is a profit sharing arrangement between two parties usually, where one party will provide the capital and the other party will provide the labor or the work, the management, and a profit sharing ratio will be agreed upon between the parties. Now, can we have a benchmark for the mudaraba profit? Now the thing is, when we are determining the profit sharing ratio, the requirement is firstly it has to be clearly known in a manner that eliminates uncertainty, okay, and any possibility of dispute. And it will be on the basis of agreed percentage of profit, not on the basis of a lump sum or percentage of the capital. So this is very basic requirement of determining a profit sharing ratio. I think, okay. So now what happens when we want to benchmark to, let's say, a known benchmark, okay? So when we determine a profit sharing ratio, it's actually a function of profit. Profit sharing ratio is actually a share percentage of the profit, and profit is basically after we deduct all direct expenses from the gross revenues. So this is where we get profit. Now we are agreeing on a profit sharing ratio, on a profit. We are not agreeing on a lump sum, on a specific percentage. Either that's a percentage of the capital or any other percentage. Basically, we cannot assume any other percentage. Definitely, it has to be a percentage of the capital. So we cannot do that. Now, what we can do, we can use the benchmark. Let's say in any given benchmark, the benchmark of the return, let's say, is 10%. Okay, assuming it's 10%. Now, what we can do, we can back calculate. Okay, in order to get 10% return on capital, how much profit sharing ratio we need, right? So then we have to work out. We have to look at the previous tenures profits. We have to also project the future tenures as well, right? So based on that, based on the projections, let's say we project that there would be a total profit of, let's say 20%. Okay. And then based on the benchmark, we want to achieve at least 10%. So the investors want at least 10%, 10% meaning that 10% of 10% relevant related to capital, percentage of capital. Now, the projection is that there will be a total 20% profit and we want 10%. So what does it mean? We want 50% profit. So what we can do, we can, based on that benchmark, we can agree on a 50-50 profit sharing ratio. So basically between the Mudarib and Rabbul Mal, between the fund provider and fund manager, they will share 50-50%. We can further introduce cap. So here you can see in either of the clauses, I'm not sure, I forgot in which clauses, but I mean somewhere here, it's somewhere here, that there could be a profit cap as well. What it means, so let's say we say it's a 50-50 profit, but the investor's profit will be capped at 10% ROI. What does it mean? So let's say at 50% profit, we get 12%. So there is a 24% profit this year. And suddenly out of 24%, if you count 50%, so there should be a 12% ROI to the investor. But we have a cap of 10%, meaning that the investor will get up to 10% and the rest additional 2% will go to the Mudarib, to the fund manager, to the entrepreneur. That is fine. But we cannot have a floor. We cannot say otherwise, like, okay, at least 10% will go to the investor. Because if we say that, there could be a scenario that there is less than 10% profit or just 10%. So in both cases, profit entirely goes to one party. And AAOIFI makes it very clear that you cannot make any such profit sharing ratio, profit sharing mechanism, in which case one of the parties has the possibility to completely get deprived of profit. So as long as we do that, the benchmark is fine. So the benchmark is just to determine the profit sharing ratio. That's fine. But we cannot have the benchmark as the decisive return formula. Like we cannot say, okay, whatever the PSR is, I need to get up to that benchmark. So then this is where we will have some uncertainty. We will also have some certain percentage of the capital. A lot of issues will come in. So I hope that is clear to the one who has questioned. Thank you so much. Next, let's say, okay, this one I answered already. What is the difference between security deposit and Hamish Jidiyah? Okay. You can find the discussions on Hamish Jidiyah in Murabaha, for example. In Murabaha, you can find discussions. I think most probably you have in definitions as well about Hamish Jidiyah and Arbun. So Hamish Jidiyah comes at the stage of wa'd or promise. So the customer comes to the financial institutions. The customer places a request that I want to purchase that asset. Can you buy it for me? And then the institution proceeds with the purchase. And before that, the institution requires the customer to place some deposit. So this is what we know as Hamish Jidiyah, right? And the hukum or the ruling of Hamish Jidiyah is that if there is if the customer backs out, you cannot freeze the entire amount. Rather, you can only take the actual loss borne by the institution. So, for example, the institution has procured the asset at, let's say, $100,000, and then it was supposed to sell the asset to the customer at $115,000, 115. And because the customer has backed out, it had to sell the same asset to an open market. And they were only able to sell at, let's say, $102,000. Now, is there any actual loss? No, because the institution was able to recover the price that it has paid. So it has to return the entire Hamish Jiddiya to the customer. However, if it was able to sell at, let's say $95,000, where you have a deficit of $5,000 or actual loss of $5,000, then you can recover that amount from Hamish Jiddiya. So again, Hamish Jiddiya comes at the stage of Wad, before the sale agreement. There is another similar concept which is known as Arbun. Arbun comes at the stage when the sale contract has been concluded. So it is something like advance payment. So after the sale has concluded, I'm giving some payment. This will be part of the entire price being paid, but it is just like giving a assurance that I'm coming back to pay the full price. However, if the customer at some point says, no, sorry, I cannot pay and I have to back out. In that case, the ruling is the financial institution or the seller can freeze the entire amount, but it is still good. It is still a good practice to return any amount above the actual loss, just like Hamish Jiddiya. So I hope the difference. Now which one would be called security deposit? I believe Hamish Jiddiya would be more like a security deposit, you can call it. Okay, thank you for the question. I think this one I already answered. Muhammad Wadi. Okay, Assalamu alaikum. Wa alaikum salam wa rahmatullahi wa barakatuh. Can you explain which standard will be referred to look at set-offs? And if you can explain what is permissible. Okay, set-off is this one. Shariah Standard number 4, settlement of debts by set-off. So set-off is basically where in Arabic we call it muqasa. Let's say if you look at Arabic, so you can see Shariah Standard number 4, al-muqasa, right? So muqasa means basically I owe something to you and you owe something to me, and we decide that, okay, we set this off against that. So that's basically the very basic understanding. Now, in some cases, it will be mandatory. In some cases, it will not be mandatory. It will be contractual. I will not go to the details. You can find the details in the Shariah Standard itself. If you have any particular query, you can ask, and we can try to approach to answer it, inshallah. Okay, and then please, can you elaborate the role of SSB, how they relate to the setting and monitoring of standards? Okay, I don't have the governance standard open here in this slide, in this window, but I can explain very quickly. So the first governance standard issued by AAOIFI is on SSB, or Shariah Supervisory Board. And you can see the role there. So Shariah Supervisory Board's role is basically to give fatwa, whenever there is a query from the board, and also to do an annual review and issue the report for the shareholders. That's in very general is their role. But end of the day, the management is responsible for ensuring Sharia compliance at all times. Right now, how they relate to the setting and monitoring of standards, I think the question is like, how do they ensure that the standards are being followed or implemented? So their role again is more on review, but they have to they have to be accompanied with by internal Sharia audit, internal Sharia review, which the governance standard number 2, 3 addresses, and then a very latest one, which is not part of the upcoming CSAA exam, but it's definitely worth it to look at, is the IFSB and IOFI Sharia governance framework, which is still in the draft stage. And if you look into it, you will see further additions to the previous Sharia governance standards that has been issued as part of Sharia governance standard by IOFI. And the role of SSB is further detailed. But again, in general, their role is basically to provide guidance, to provide advisory, to provide fatwa, to also conduct annual Sharia reviews, but they have to be assisted with few other teams like internal Sharia audit, internal Sharia review, etc. I hope that answers your question. Jazakumullah khairan. Okay, what is the ruling on exchanging gold with a new gold in general way practiced today in the shops? Is the same ruling. We have to basically have it on spot as well as an equal amount. Now, definitely when we go to the jewelry shop, that's not what's going to happen. So the one alternative is to sell the old gold first and take the cash, then purchase it for cash, purchase the new gold for cash. All right, medium and minor gharar is permissible in contract. There is a question from Mr. Aminur Rahman. There is a separate Shariah standard on gharar. I believe it's yeah, this one, Shariah standard number 31, controls on gharar in financial transactions. So there are different types of gharar basically is uncertainty. Now, in terms of degree, it can be excessive, it can be medium, it can be minor, right? So the main the main ruling here is that it is impermissible in Sharia to conclude a contract or stipulation or condition that involves a degree of gharar which could jeopardize the fulfillment of the contract's stipulations. Now, in Sharia, as we know, Allah subhanahu wa ta'ala mentioned in Quran al-Kareem, وَلَا تَأْكُلُوا أَمْوَالَكُمْ بَيْنَكُمْ بِالْبَاطِلِ إِلَّا أَن تَكُونَ تِجَارَةً عَنْ تَرَاضٍ مِنْكُمْ. Right? You can only consume each other's wealth through tijara, إِلَّا أَن تَكُونَ تِجَارَةً عَنْ تَرَاضٍ مِنْكُمْ, through tijara, which is based on mutual consent, taradi. Now, to have taradi, we need to have we should eliminate information asymmetry. So the material information must be disclosed and understood by the parties. And this is why we need certainty or specifications of the product, specifications of the price, etc., etc., etc. Now, gharar, what does gharar do? Gharar comes into the picture and basically damages the entire concept because it brings material uncertainty and ambiguity, which may lead to dispute. So when the degree of gharar is major, in terms of material information, then it is impermissible, and what it does, it makes the contract facet, in some cases batil. And then we have number 4, it actually mentions that gharar violates the transaction when it fulfills 4 conditions, right? So number 1, it has to be an exchange based contract. So if you have gharar, for example, in a donation contract, it doesn't matter, the donation will be complete even with the gharar. Number 2 is it is excessive in degree. So again, what is the excessive can be subjective, but in general, it is so much uncertainty to the material information of the contract that leads to dispute. So that's in general, and it relates to the primary subject matter of the contract, and it is not justified by a Sharia recognizable necessity. Now, who would decide is it justified by a Sharia recognizable necessity or not? This is the role of Sharia Supervisory Board. They would debate, they would argue, and then they would basically decide if it's a Sharia recognizable necessity or not. So I hope that answers your question, Muhammad Aminur Rahman. Thank you for asking. Brother Imtiaz asking, Assalamu alaikum. Can a conventional underwriter cover a portion of a claim while the takaful fund is growing? Interesting question. Let us have a quick look at the takaful Shariah standard. So this is the one. What is it? This is Islamic reinsurance. Here, Shariah standard 26. Okay, so in terms of underwriting a portion of claim, if you look from, I think if let's look at the reinsurance. Okay, so basically, if we look at this Shariah standard of Islamic reinsurance, we find here it is impermissible for Islamic insurance companies to reinsure with traditional reinsurance companies, except when such reinsurance is sought as a transitional arrangement stemming from public need, which amounts to necessity. Right? I think this puts us the ground principle here. So in general, when it comes to underwriting the claims or having a takaful reinsurance company, an Islamic insurance company or takaful company must go for Islamic insurance companies. But when we are just starting, let's say in a country where there was no takaful companies and we are just starting it, right? So at the very beginning, we may have just able to secure the client side, meaning the participants of takaful may come in, but we don't have the underwriters yet. We don't have the reinsurance yet. So in such cases, we can have traditional reinsurance companies or traditional underwriters, but of course, the principles must be the Islamic principles. And number two is most important is it is a transitional arrangement. It is a temporary arrangement. It is not a permanent arrangement. So there has to be a game plan, a timeline, a blueprint or whatever we call it for the long run, so that we can fully transition to Islamic in all aspects, Islamic takaful. So I hope that answers your question, brother. Jazakumullah khairan. Okay, please explain 3125 or SS12. Okay, Allahul Musta'an. Allah give me tawfiq to explain, inshallah. 3125. Okay. Dear brothers and sisters, I might be wrong. I'm just trying to answer you live, right? So please verify yourself as well. We are just trying to help each other. Don't consider me like a ustaz or something. I'm just sharing with you some of the experiences and knowledge Allah subhanahu wa ta'ala has given us. That's it. But please try to go yourself as well and try to verify yourself as well. Okay, 3125. What is this about? It is about the capital of Sharika. Okay, the discussion is about the capital of Sharika. The capital of Sharika. Sharika means the company, the partnership, the stock company. All will be included in Sharika. Now, what is the question? Just explaining. Okay, the funds of current accounts, although they are jurisdically classified as loans to the institutions, can be presented as a contribution to the capital in Sharika, either with the institution itself or with a third party. Okay, got it. So basically, when it comes to a capital of a company, there are certain requirements for the capital. The first and foremost, it can be in the form of monetary assets. So I can give, let's say, $100,000 as capital. Okay. Then it can be also tangible assets or commodities, but the condition is it has to be valued determined in a currency, right? So I hope this is already understood. I'm just setting the context, and I'm leaving out this one. This is basically different currency. Then this one is about, okay, now this one. So this is where it comes, 3125 comes from. So in 3124, it says it is not permitted that debts alone be used as a contribution to the Sharika capital. Now, why is it that? I just mentioned in answer to one of the queries that the subject matter in Mudaraba Musharaka is a ribh or profit. We give money, we give capital. Why? So that it can be invested in a profit generating activities, and thereby we share the profit. Now, if the capital is debt, capital itself is a debt. We don't have access to the capital. We cannot use the capital. We cannot plan the capital into a profit generating activity. So it defies the purpose, right? We don't generate profit, so we cannot share profit. That's the whole reason why we cannot consider debt as capital. I hope you get the point. Now, in the next one, what it says is that someone would argue, hey, you said, you cannot consider debt as capital. What about current accounts? You mentioned current accounts is also a loan given by the depositor to the institution. Now, can we use our current account balance as the capital of a company, as a capital contribution? Now, the answer here is yes, right? So even though jurisdictionally, even though from fiqh perspective, we categorize as loan, but still it can be used as capital. Now, why? I hope the answer is very obvious, because unlike debt, this is cash, right? Even though it's considered as a loan, but the moment you give check or any other way to withdraw it, you can get it. And once you are able to get it, you can deploy it for profit generating activities. So the whole whole rationale why debt was not considered as a capital is not found here. So that's why this one is valid, but that one was not valid. I hope this answers the question. Okay. What does ju'ala mean and how is it different from ijara? Okay, very good question, but very basic question though. We'll try to address as well, inshallah. So ju'ala is a contract where you define ju'al. Now, what is ju'al? Ju'al is like an award. So we say, okay, we will give an award to whom? Who can get into this outcome, a certain outcome, who is able to achieve a certain outcome. So for example, who is able to collect the receivables for me, who is able to get me new clients. So it can be designed in a lot of different ways. In contrary, ijara is basically based on services. So for example, if I employ someone as a salesperson based on ijara, what I will put is you have to work, let's say 3 hours, 4 hours, 5 hours, or you have to work on a project, this and that, and this is how you will get paid for. And the services must be very specific because in ijara, the subject matter is the work, the service. So in all Sharia, in the whole fiqh muamala, the subject matter has to be super specified, so there is no ambiguity. And this is why when we conclude an employment contract, we have to specify what type of work you would do. Of course, there could be some variations, and that must be mentioned as well. That for the sake of the company, you may have to do some other jobs as well. So that is agreed upon between the parties, right? Now, in Ju'ala, we don't agree upon the services provided. We agree upon the outcome. We don't say you have to work 3 hours, 4 hours, 10 hours, whatever. But we say you have to bring a client, you have to sell, you have to, get certain outcome, certain results, right? So, and the award, here in Ijara, we call it ujra or fees. In Ju'ala, we call ju'al or award. Now, the award can be a function of a percentage of the total outcome. So, for example, we announce that whoever helps us to collect our receivables will get, let's say, 5% of the total receivables collected. So that is fine. We can also mention as a lump sum. We can also mention as a tangible asset or whatever. So that's basically the difference between ju'ala and ijara. So in whatever cases we are unable to do ijara due to unspecification of the services, etc., highly likely we can do ju'ala. But of course, ju'ala also comes with its own conditions we have to take care of. Okay. Then please explain Sharika chapter 4.3 partnership in commendam and partner allotment partnership. I am leaving that, Brother Abdul Rob. Thank you for asking. Because some of those partnerships I am also not fully familiar with. As we know today, we are more familiar with private limited companies, public limited companies. Those have some similarities with what has been mentioned in the partnership in commendam, etc. But I also don't have practical exposure of all those types. But nonetheless, the main thing that we have to take away from that chapter, that Shariah standard of Musharaka, is the rules of profit, the rules of loss, the rules or principles of capital management, liquidation. So those are the important ones. Now, the different types of partnership that is mentioned there is just to give the context that those are the traditional ones, like Shirkatul Wujuh, Shirkatul A'mal, Shirkatul Zimam. Those are the traditional ones, Shirkatul Inan. And now we have some modern types. So the modern types, the purpose is not to say those are the only types. There could be many other types, many other variations coming in the future. But the principles are same. The principles of profit, loss, etc., that has been mentioned in that particular Shariah standard, the underlying things are quite same. Okay. Next question, let us address on what ground Juala is different. Okay, I think we already understand. Abdul Khair Sarkar from please discuss on concession contract. Okay, let's discuss on concession contract. I believe it's here, Shariah Standard number 22. So concession contracts are basically sometimes some licenses are given to some parties for utilization of minerals, waters, etc., or some construction of projects, and those licenses are kind of given to very specific entities, etc. Right? So the purpose of this standard is like how we consider those contracts and the underlying procedures, rights and duties. So for example, someone has been given a contract by the government or a license by the government to, let's say, produce electricity or gas. All those are very, very required public utility. Now, what type of power does it give you? Like, can you do everything that you want, or you have some limitations, restrictions? How does Sharia look into this? Those are the very basis, basically, tried to explain here. So first and foremost, how does Sharia look at the permissibility of the concession contracts? Then the offering, how does the, let's say, if I'm to offer, if we are to offer such concession contracts, what are the things we have to consider? So for example, we have to, look into the justice and equality of chances. So there should be no corruption, that we are only, giving the option to some certain parties and not giving to others, or we are dealing, under the table, for example, nauzubillah min zalik. Rather, it should be based on fairness, justice, and public interest, etc. Then it has further gone into some current affairs in terms of concession contracts, for example, for utilization in case of, minerals, waters, etc. How does it happen? And then what are the formal procedures? And if there is any Sharia issues, for example, granting survey license, granting exploration license. In many Muslim countries, oil producing countries, for example, those are relevant to those countries as well. And yeah, so I think the standard is very straightforward. If you have a question about any very specific issue, maybe I would be happy to answer about it. But other than that, the standard is quite straightforward. So as you can see, we have just discussed about Juala, right? So you can see the Sharia classifies such contracts. What are such contracts? The utilization concession contracts. So Sharia utilizes such contracts as a form of Juala, you see, where the state is Ja'il. Ja'il is like in Ijara, in service contract, the lessor, or the one who is recruiting, employer, is similar to Ja'il. In other words, a Juala initiator. And then the licensing institution is the Amil, the one who is basically hired to do the work. And the specific amount to be received by the latter is the Jol. So usually in the concession contracts, how does it work is that the one who is utilizing the minerals or such, like for example, here we mentioned about water, etc. He will have a certain commission, certain percentage, and that's the fees that he is going to earn. And it is not based on the services provided. So for example, it's not like, okay, if you run your machine for 1 year, you get this much. No, we don't care if you run your machine or not. What we care is if you are able to utilize it, if you are able to, produce the oil, refine the oil, for example. So it makes more sense to do Juala contract than to do Ijara contract. And that's what has been detailed in this Sharia standard. I hope that answers your question, Brother Abdul Khair. Jazakumullah khairan. Assalamu alaikum. Please explain procrastinating debtor. Procrastinating debtor is the debtor who doesn't want to pay. That's in a very layman terms, right? He has the ability to pay, but he doesn't want to pay. And unfortunately, that's the mindset of most people in today's world. They want to take loan not to repay. They just want to find other way to basically forego the obligation to payment. However, in Sharia, we will find a lot of emphasis given into, firstly, of course, not to take loan other than dire necessity. Secondly, even if you take loan, to pay it on time, because Prophet ﷺ has mentioned, Matalul Ghani Yuzulmun, the procrastination or delaying of payment by a Ghani, by the one who has the money to repay, is considered a zulm, a form of oppression, a financial oppression. And there is traditions from Rasulullah SAW as well, that he kind of denied leading janaza for those who left debt without repaying, or without having someone as a representative to pay the debt on their behalf. And the moment it was assured that someone else took the the representation from the debtor, the dead person, to pay on his behalf, this is when Prophet ﷺ was ready to pray his janazah. So it showed the hatred that he showed towards the person who left debt without being paid. Now, this whole Shariah standard is about those who firstly don't pay because even though they have the ability. So firstly, how does Sharia look into it? So as you can see, the default in payment by a debtor who is capable of paying the debt is haram. It is considered prohibited. Right? So this is the very first bold statement made by AAOIFI standard. And now, if someone has defaulted, how do we treat it? Right? So can we charge penalties? Can we charge compensations? So then it goes into further details. Then what about if there is a guarantor? How will it be treated? Yeah, so those things are basically taken into care and then taken into consideration. Then what about non-material punishments? Can the financial institution blacklist, for example, the defaulter? So those has been discussed in detail. So I hope you get the general understanding, Mr. Fahim. Jazakumullah khairan. Please say about indices. Indices are basically indexes. So let me go to here. Indices, Shariah standard number 27. Indices are basically indexes. For example, we have different types of indexes. If we look at the definition, it says an index is a statistically computed figure based on the selected package of financial papers or commodities dealt in organized or non-organized financial markets. So it's basically numbers. End of the day, index are numbers. Now, how we compute those numbers? This will be usually based on a package of financial paper or commodities. In commodities exchange, it will be based on commodities. In the stock exchange, it will be on financial papers like shares, bonds, etc. And then each paper or commodity will be given a weight according to its market value. And then the total value will be divided by a constant figure. So this is basically the way of computing those numbers. End of the day, index is basically a number. Now, the question is why? So then the next clause explains it. It is basically designed to measure the market situation. So for example, inflation rate, for example, right? In the macro level, in the country level, we have some macro indicators like inflation rate, we have GDP, gross domestic product, we have unemployment rate. So what does those numbers give us? So we, for example, inflation rate, 5%, for example, what does it mean? We basically compare this year to the previous year. So thereby we know if we are progressing or if we are going backward. So similarly, in terms of index, it gives us a measure about the market situation. Is the market has a higher demand? Do we foresee that the prices will go up, or the market is seeing a negative reaction? So those things we understand from the index usually. And end of the day, how does it help? It helps us by forecasting the future developments before any changes takes place, and that thus facilitates investment decisions. So traditionally, for example, if in the property market, for example, right? So how do we know if the price of a property will go up? So we may go and ask individuals, market players, buyers, do you think this property is good? Do you think this the price of this property will go up? This and that. So now, when it comes to a sophisticated market, you have a large number of buyers and sellers. How do you make those predictions and future, development forecasting, for example, and not only based on assumptions without data, rather based on actual data and also simulations based on econometrics, statistical computations, etc. So this is where the index helps us. So end of the day, that's it. But now the question is why IOFI has this Shariah standard. Now, firstly, of course, the index itself, because end of the day it's numbers, end of the day it's some maybe some percentages. So it may have some impression, hey, there is some percentage, maybe it's riba. I mean, some very layman thing. I hope this question is no longer there, but that could be a very layman question. So first and foremost, how Sharia sees that, perceives those indexes. So that is something that IOFI has dealt with in Sharia standard. And secondly, of course, how can we use those indexes? How can we benefit from those? So as you can see, it is permissible in Sharia to use indices to discern the magnitude of change in certain markets. So if you want to see, for example, how much change in the market happened due to COVID, for example, or due to any big event, or due to any uncertainty in the market. So we can look at the index and that will give us the answer. So in general, to basically get those answers based on index, it is permissible, no issue. Even we can use the index to benchmark in our in various returns, or even comparison of funds and investment bonds. Those are also fine, no issue. And furthermore, we can also use a benchmark, which is a benchmark of interest, for example, but we are using that to price our murabaha, to price our own sales, etc. No issue, because what we are doing here is we are just benchmarking. We are just taking, what is benchmarking? We are just taking an idea. We are just assuming that since they are at going at that rate, perhaps the best rate for my return in my business is also something similar. So that's what we can explain the benchmark as. And Sharia has no issue, as long as it does not contravene with any other Sharia requirements. For example, in a sale contract, the price must be specified and ascertained. Now, if we say, the price is no longer specified and it will be variable up and down with the benchmark, then it will be a Sharia issue, right? Similarly, in mudaraba, musharaka, the profit sharing ratio must be specified, all right? Now, if you say, there is no profit sharing ratio, it's based on that benchmark. So it will go up and down, up and down. So those are the issues or concerns of Sharia. Otherwise, just to benchmark it, there is no issue. And there are, if you see, if this in this Sharia standard, all are permissible, it is permissible. All of those things, most of the uses are permissible. Yes, there are some impermissible uses as well, and those are highlighted. So I will leave those. Hopefully I answered your question. Which is the latest version of IOFI standard? I can only have that of 2017. Please go to IOFI's website. The latest version, it is updated every year. The latest version, I hope, is updated a few months ago, and you should be able to find it for free, available to download in IOFI's website. Can you please explain about binding and non-binding contracts? Contracts are basically binding. The moment we agree, the moment we accept an offer, it is binding. It is binding. Now, in some cases, there could be an option. There are few options in Sharia. I think there is a separate Sharia standard here. So there are few like options to reconsider, like 52. I think this one is, you don't have to prepare for this for the upcoming CSAA exam, but definitely you can go later on. There is also an option for option to terminate due to breach of trust, but that's a different types of options. In sale contracts, you will have options like khiyar or shart. You will have, it's a general option. You can have like, okay, we will have an option to terminate for 3 days, for example, whereby within these 3 days, any party can come and terminate. Then you will have also khiyarul wasf, which is an option of we can call quality, for example. If the quality or feature doesn't meet the one that has been mentioned, there is an option to terminate the contract as well and get refund, or you just take it as it is. Then there is also an option of khiyarut ta'yin, option of certainty. So where, for example, we have purchased fungible items, but we haven't ascertained that I'm purchasing particularly this part or this one, right? So after the contract, the buyer has an option to choose between the two different commodities. Of course, those are fungibles; those are of similar qualities and specifications. Similarly, there is also here ru'ya, which is option of inspection. When we buy something which we haven't seen it, and later on we come home and we see that there was some defect or something. If there is a defect, then we also have khiyarul aib, which is an option of defect. Even if there is no defect, but we have perceived it to be something, and then later on when we saw it, it is something else, we have here ru'ya as well. So there are some such options in fiqh literature. Other than that, every contract signed is binding. What do we mean by binding? That you cannot make any changes unilaterally, right? You can only make changes to it, of course, mutually if agreed upon. And of course, if it's a sale contract, then there are some additional requirements as well. If it's a musharaka mudaraba contract, both parties can mutually agree upon, let's say, a different profit sharing ratio, no issue. If it's a ijara contract, the parties can agree on a different rental, no issue. But for sale contract, especially when the subject matter has already perished, it has been consumed, then the options are limited. The other options to mutually agree upon a different price is limited, because that may result into a late penalty charges, which is also considered as a riba from AAOIFI point of view. So I hope that answers your question. I tried to make it a bit detailed. What is urf? Urf is basically the custom, the customary practices. In Sharia, urf has a stance when we determine Sharia rulings, because we need to consider not only the wordings, but also how people behave, how people act in the market is also very important. Okay, please explain SS 37, credit agreement 5.3. Okay, let's try to do that. Shariah number 37.
Assalamu alaikum, Sheikh.
Yeah, walaikum salam, brother. I was speaking non-stop. You should have stopped me.
I just wanted to thank you and remind you, Sheikh, that we are over time. If you have a commitment, you're not obliged. Means like I know you everybody is so keen to ask questions, but if you want to continue, we can. But I think what would be the best?
How many questions we have? I think let's answer those in the Q&A section very quickly. The 6 questions we have.
All right, Sheikh.
And inshallah, Jazakumullah khairan for your reminder. So the question was about this clause, I believe, 5.3, which is returns and commission on credit facilities. I think this is something similar to what we answered previously on documentary credits as well. So if we look at the first type, which is commissions and returns which arise from contracting. So for example, commission for credit study. The institution is permitted to take commission for the credit study it prepares internally or through external party, so as to know the creditworthiness of the client and his ability to honor his commitments within the period given. So basically, this is like a due diligence, but from credit perspective, a credit assessment. So if there is a commission that institution wants to charge for it, they can charge it, no problem. Now, entitlement of the institution to such commission is due to the fact that the client has benefited from the study, regardless of whether the study has led to acceptance or rejection of his request. And the study shall become the property of the client who has the right to take it. So this is basically the rationale why AAOIFI is saying that the institution can charge commission for the study, because at the end of the day, it's the property of the client and the client can benefit from it, either or not he is getting the credit. So it's a different thing from the credit. It's not charging from the credit. We are trying to establish that. Previously also I mentioned, we cannot charge for the credit, we cannot charge for the guarantee, but if there is an additional service provided, we can charge for it. Now the commission for offering credit facilities, this commission refers to the amount which the institution charges against allocating and specifying the limits of the facility. The institution usually charges such commission whether the deal is finalized or not. However, it is impermissible for the institution to obtain commission for offering credit facilities because the mere indication of willingness to enter into a lending and borrowing transaction does not justify remuneration. So just because there is a commitment from the institution that it will give some credit facility, it is not a service. So the first one was a service, it was a rightful service, but this is not a rightful service. And hence, it does not justify remuneration and the institution cannot charge commission for it. What about renewal or extension of credit facilities? Now, the type of commission should be treated in the same way like commission for offering credit facilities, meaning we just read this one, right? So what we are saying here, it is not permissible. It is not justified. Same here, when we are basically extending the duration of the credit facility, there is no services rendered. Hence, the institution cannot charge any fees. So I hope the three sub clauses are clear. The main idea is if there is any additional service, legitimate service, then yeah, there can be. Yeah. Assalamu alaikum from Kazim. Assalamu alaikum. What is the relationship between external Sharia auditor and external auditor? Who reviews the report of the other before final report is submitted to the shareholders? This is a tricky question. I don't remember exactly what is mentioned in AAOIFI governance standard. But in general, the practices can be different. It's not a Sharia requirement, by the way, it's a governance requirement. What is AAOIFI's requirement? I cannot recall right now. You can go to the governance standards and see, especially on the external auditor, because that's not part of the curriculum for the upcoming CSAA exam. But in general, if you're talking about external auditor as the external financial auditor, so usually a financial audit would be leveraged on when it comes to Sharia audit, because a lot of information usually Sharia audit will leverage on when based on the financial audit. So I think if you are asking a relationship between the external Sharia auditor and external financial auditor, most probably external Sharia auditor will also leverage on the external financial auditor plus the internal Sharia audit as well. But please recheck. Especially, I would highly recommend the recent AAOIFI and IFSB Sharia governance framework, which is still in the draft phase. Please go through it. I'm rejecting the question, not rejecting, basically, I'm not going to answer the question, what is asset based and asset backed, Brother Abdul Rob, because this is, I think we have this answer in Sukuk most probably, but if not, you can easily find it. Is if a vehicle is completely destroyed in a Ijara Muntahiya bit Tamliq transaction, who bears the loss? What happens in a partial destroyed scenario? If a vehicle is completely destroyed in a Ijara Muntahiya bit Tamliq, so generally from the Ijara point of view, right, or from the ownership point of view, when an asset is completely destroyed, so there are two things. In Ijara Muntahiya bit Tamliq, we have an aspect of joint ownership, and we also have or co-ownership, and we have an aspect of lease or Ijara as well. Now, for the co-ownership, theoretically, based on the asset ownership ratio, so let's say if it is standing at a 50-50 ownership ratio, then the financial institution and the person must jointly take the loss, bear the loss together. However, if they are also subscribing to insurance or takaful, then the takaful is supposedly would be covering that, whereby the takaful contribution might have paid by the financial institution. In Ijara context, any ownership related expense, including takaful or insurance, must be paid by the owner, not the owner or the lessor, not the lessee. Now the lessee can pay, but he has to get a reimburse from the lessor. So in this case, if the takaful premiums are paid, he should get it I believe by the takaful company. However, if let's assume it's destroyed and it's not recovered, In that case, as based on the principles of shirkatul milk or co-ownership, they should jointly bear the loss, as well as the rent also would stop, because the moment it is not able to give benefit or any utility, we cannot get any rent out of it. That's a very basic principle of ijara. So I hope that answers your question. Can you please explain mandatory and contractual set off in brief? I'm trying to avoid that, Brother Sajjad, because sorry, because I briefly explained that set off. If the investment opportunity is 800 and shareholders fund is 100 and investors fund is 1000, how should we prioritize their funds for the investment? Okay, if the investment opportunity is 800, shareholders fund is 100, and investors fund in 1000. How should we prioritize their funds for the investment? Now, are we trying to prioritize their funds in terms of dividend? I don't believe so, because you asked for investment, but I'm unable to conceptualize how we can prioritize their funds for investment. Is it that we are saying that there has been an investment opportunity of 800, whereby existing shareholders are coming with 100 and the investors are coming with 1000? I'm sorry, I'm unable to conceptualize that. Maybe you can come to Mike and explain further. I can try to answer, inshallah. Okay, kindly explain the concept of life takaful. Okay, I have to stop right now. Mr. Jibril, perhaps you can ask the question directly to either TAIF or Adil, and inshallah we'll try to answer your question separately. For the sake of today's session, which we have just finished, the questions that we had. Do we have any question in the chat box? Oh yeah, there has been some questions, I believe, in the chat box, but I think we answered those, right, Brother Hassan?
Yes, yeah, all of them is answered. Is there's one last question that I've sent to you, if you can answer.
Which one is that? Sorry. Brother Hassan, where did you send, please?
Sure, directly to you. I've sent directly to you. Okay, let me.
Oh, okay, all right. If there is a linkage between Islamic reinsurance and traditional reinsurance accounts contract, then the gains made on insurance are definitely illegal. Whose fault is this? What actions should be taken against the suspect according to Sharia? All right, this is a big question. I think I don't have any direct answer from the AAOIFI standards. Perhaps you can contact us later and we'll try to answer your query. Of course, by also considering other factors, inshallah. I hope that answers your question. Thank you.
Jazakallah Sheikh. Thank you very much, everyone, for joining. Sheikh, thank you for giving time, and I believe extra time more than usual. I'm sharing Sheikh's LinkedIn profile in the chat. Kindly, please follow Sheikh and other advisory and benefit from them. Check out the website. They are providing a lot of services. Sheikh, thank you very much again for your time, and I think that you have benefited from your.
Do you want me to answer one last question? This Muhammad Buhaidida asked, Brother Hassan.
Sure.
Okay, I think you asked about ما هي الابتكارات الحاصلة اليوم فيما يخص تقليل المخاطر في أساليب التمويل القائمة على المشاركة في الأرباح والخسائر. So, what are the innovations now, basically, when it comes to mitigating the risk in a financing based on musharaka, for example? I think this is a question often being discussed today. Like when we talk about musharaka and mudaraba, often also comes into the discussion is about the risks, the moral hazards, especially the non-transparency of books and accounts, the issues of trust, etc., etc. But what we can say today is, for example, if you are, instead of considering musharaka for the entire company, if you consider musharaka for a specific project financing, like it can be done, let's say, for crowdfunding as well. And we have advised one crowdfunding company in Indonesia, which is to do musharaka for work order financing, and they have been doing that for almost 2 years. and they have been quite successful in doing that. The beauty of that is it's done for a very specific project. So you ring fence the risks, and the profits, expected profits are quite also well understood, well calculated. So it's easier to maintain and it's easier to mitigate the risks. Other than that, if we want to do in a larger scale, the innovations today we have in terms of technology, we can have shared accounts, for example, where the financial institution or the ones who is investing can also have access to accounts, maybe a view access. They can also have more visibility, more more understanding and more reports to the investors. I think those things can mitigate the risk. And if we look at, for example, microcredit institutions in different countries, they are developing a lot of software through which they can predict the defaulting clients. So I think somewhat similar can be utilized in case of Musharaka Mudaraba as well. But it's more on the depositors as well to undertake the risks if there is any. Because end of the day, what can be mitigated is mostly moral hazard, etc., etc. But the business risk is still will be more or less there, and the depositors should be ready to take that. Then only the financial institutions can do that. So I hope that answers your question. Thank you so much for attending and asking this question. So I think we can end this session, Brother Hassan. Jazakumullah khairan, and thank you everyone also for attending. And please follow and like and share TAIF as well as Adil Advisory. At TAIF, you can find a lot of different learning programs for different Islamic finance topics and subjects. And in Adil Advisory, we provide basically Shariah advisory and Shariah certification. We are registered with Securities Commission of Malaysia, and we advise more. Our portfolio consists of more Islamic fintech portfolio like crowdfunding, robo advisory, takaful tech, blockchain-based solutions, etc., and also sukuk. But we are also able to advise on other matters when it comes to Islamic finance. So please do reach us if you have any questions or any other relevant matters. Thank you so much. Jazakumullah khairan.
Assalamu alaikum.
Wa alaikum assalam wa rahmatullahi wa barakatuh.